Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, very good. Evan, I wanted to talk straight away about the latest wages data that's come out. I, for one, am not that excited about it, but let's have a chat anyway. One of the things I wanted to do was just to really read off some of the core data figures, but let's talk generally about the data that's just come out.
Yeah, I'm not enthralled by it either. It's better, that's great, but it is still very anemic. Let's be dead honest. So the headline figure of 2.1% was better than consensus. That's a year-on-year figure. It rose by 0.6 of 1% quarter-on-quarter. So that's all well and good. However, if you drill into it, it's really not brilliant at all. So public sector growth and wages again, which is also a very volatile part of the index, was the reason we're up there. So 2.4%. If you look at private, which does employ over 75% of people in this country, 1.9% year-on-year growth. So it's pretty anemic. And then when you look at it on a real wages basis, so that puts things like core inflation into it, private sector growth is 10 basis points, 0.1 of 1% above inflation. So realistically, it's inflation.
Nothing to write home about. And you look at some of the headlines today, people saying, oh, fantastic, strongest growth in 18 months. But really...
Low base.
Yeah, when you look at the data and analyse the data, which I'm just about to do, it's not, for me, it's not a signal to investors that, yay, Australia's sort of on a massive growth path.
And on that, it also reiterates what the RBA has said, particularly over the last 3 weeks, which is that underemployment in this country will likely be the headwind for wages. We know that we've had a really good employment year, and that should be championed. There's no doubt about that. But the underemployment, which is the unemployed plus the people that want to work more, if you add them together, it's underemployment or underutilization. It's still sitting well and truly above where it should be. And very quickly, to compare it to the US has had full employment, inverted commas, for about 3.5 years, and only now have they started to see wage increases that are actually showing material signs of inflation. We're only about 18 months into soaking up the underutilization issue that we have, and it's probably likely to get bigger first because more people come back into the workforce. So the RBA is very, very straight with you in saying that wage growth will be very, very gradual, and they're not expecting to see it really materializing until earliest, probably this time, more likely mid-2019, next year. So yeah, that's also the take.
And there's been a lot of talk too about the gig economy, and that's not going to go away. That's going to get bigger and bigger over time. So then that feeds into the whole underemployment.
And that's
issue.
also part of, how do you classify the gig economy? Because technically some of them fall into part-time employment because they're contracting in terms of how they actually put their work out there. And that also slightly distorts it. I mean, some people enjoy the gig economy. I mean, it is growing for a reason. The lifestyle benefits of the gig economy is clearly very, very important. And a lot of people are liking the movement towards the gig economy. It's hard to classify it. Not only that, if you look at it from a government perspective and also from a full employment perspective, it does have cons that some people will point out. You clearly don't have holiday pay, blah, blah, blah. Gig economy, people would probably argue that's not really what they're after, but it is another part of this. So let's get into the
I'll just quickly read it out really, and we can have a bit of a chat about it. But the biggest rises were in healthcare and social assistance, 2.8%, arts and recreation, 2.6%, other services, education and training, 2.4%.
Which are all standard. They are always the ones that are up the front. There is no difference there. So health particularly has the largest growth rate of wages out of any sector, and it has for almost the last 5 years.
And my reading into that is there's been a lot of industrial action in the healthcare sector, and some of the wage rises secured have fed into this data.
They have. The other one that's very interesting is you still talk about other services and also retail. We know that we had in the quarter that's just been, so this is the fourth quarter of 2017, the new mandated minimum wage increase, and that's part of that feed in as well. So if you actually strip that out of the numbers, it's almost zero in terms of what's going on. So the other thing about this is that comparatively quarter on quarter, it's maybe not that even because the new minimum wage increase was put into these figures as well.
And then when you get into other sectors which have been lower lower increases. Mining, big one for Australia, 1.4%.
Standard.
Yep. And retail, which you just talked about, real estate, rental, 1.6%. So, when you get into some of the areas of the economy which sort of really drive Australia, wage growth there's been pretty flat.
Mining's the one that's been doing that for quite a period of time. So if you go back to 2013, mining wage increases were astronomical in terms of what was going on there. If you go back to sort of 2007, which is before health sort of took over as the space, mining related industries and mining wages were growing by about 3.5–4% per annum. And you did used to hear the stories about people going and driving trucks in the mine that were earning $250,000 to do their job. That is always going to be something that you need to remember as a baseline, because therefore, with what's happened post the mining boom and changes in technology, those wages have fallen like a stone. So the same job from 10 years ago, you're actually probably getting about a third less in terms of what you're still being paid. Still very good job paying, let's be honest, but the size of jobs on offer in mining is declining, and we know that also from look at the private capital expenditure numbers. So CapEx has been an interesting one. Mining declining has been gone from about 98 billion Aussie dollars in 2012 in terms of capital into it for future spending. As of the last update, it's sitting at 33 billion. So that also means wages, etc., all that kind of investment is declining. So mining's not surprising. It's the translation part that everybody talks about, the non-mining pickup. It's coming. It's certainly not moving at the sort of rate that we were expecting. Services, that's financial services, things like that were expected to be the slack pickup in wages, and they're not. And we now also know that that part of the market, particularly fintech and fin investment, they're the ones that are under pressure from AI and under pressure from globalization and new world technology. So that's the next part of the wages stuff to watch, is what happens in that space.
Absolutely. Well, thanks very much, Evan.
Thanks, Tony.
Thanks for joining us on The Economic View.